Good morning, everyone. My name is Eric Walters, and I appreciate you taking time to join us. Our webinar today will talk about the outlook for the election and the potential impact on the stock market and taxes. I'm thrilled to be joined today by my father, Stephen Walters, who is a veteran political reporter. If you're familiar with our Money podcast, you may have heard some of our interviews that we've done in the past. And we feel incredibly lucky, not only that my dad is a great guy, but he has amazing political experience to bring to this discussion. He has been a political reporter for 51 years, and 32 of those years covering the battleground state of Wisconsin. And during his time, he was the bureau chief at the Milwaukee Journal Sentinel. He was also an adjunct professor of journalism at the University of Wisconsin-Madison. And for the last 10 years or so, he's been a senior producer at Wisconsin Eye, which is like a version of C-SPAN for Wisconsin politics. He's covered multiple national conventions, both on the Democrat and Republican side. And so I'm thrilled to have him here and available for questions. If you're not familiar with me, I'm Eric Walters, managing partner at Summit Hill Wealth Management. We primarily work with business owners and executives to help them protect and grow their wealth through financial planning and investment management. So we're thrilled for your time. I do want to let everyone know a little housekeeping. We've muted participants right now just to avoid any background noise, and we welcome your questions. We've already had a few great ones shared ahead of time. On the bottom of the interface, you should see a little button that says chat or Q&A. So feel free to use that to input any questions during our discussion. And then of course, at the end of our discussion, we'll also open it up for any live questions. So without any further ado, I want to get started. And our format will be first, I'll ask my dad to comment on the political outlook for the election itself, to ask some questions I think I've heard frequently. And then we're going to reverse roles and I'll talk about the potential impact to the stock market and taxes. So Dad, first question, I'm curious, as a veteran political reporter, what's your take on the outlook for each of the two candidates for the White House? What are the 2 or 3 things that Biden and Trump need to do for a successful path to get to the White House?
Well, Eric, thanks very much for asking me to participate. It's a truly amazing year. Well, first of all, the election is 7 weeks from today. So you have so many things. I don't know where to start. You have the explosion of absentee mail ballots, and you have the increasing vitriol by both. President Trump, I'm just going to quote what they both say, Sleepy Joe, and now Mr. Biden says, calls our president a climate change arsonist. So the vitriol and the rhetoric keeps getting ramped up. But a little historical perspective is necessary here. When Grover Cleveland was running for president, I think in the mid-1800s, there was a charge, Ma, where's my pa, referring to a potential illegitimate child by Mr. Cleveland. And in 1856, in a Baltimore election, 5 people were killed after 2 hours of gunshots between, let me check it, members of the Democratic Party and the American Party, which was also the Know Nothing Party. So a little more historical perspective, our country was founded by political parties starting their own magazines, newspapers, periodicals. So I kind of see us coming back to that. Have I successfully not answered your question on predictions? Because I'm not going to do that, but I can list kind of 6 major factors that I'm going to watch over the next 6 weeks if you want me to do that.
Please do.
By the way, I'm supposed to be interviewing you. You're interviewing me. How does this work?
This is the great reversal. Now the interviewer is on the spot.
Oh my, it's always been troublesome. No, I don't mean that. Okay, let's talk about the pandemic on October 30th. Today we have 194,000 deaths in America, 6.5 million that are positive. And what are those totals going to be in October 30th? But let's also view the pandemic from, will 1 million people in America have been vaccinated by that date? So those are numbers to watch. Second factor, let's talk about potential areas of civil unrest and riots. I love the state of Wisconsin. I've turned down Washington assignments twice. Boo, Washington. But we saw it here in Kenosha. Will there be future Portlands, Seattle, Chicago, and Kenosha's? Because that could underscore the president's law and order message. Let's talk about performance in the debates. You know, in 2016, President Trump kind of dominated Democratic nominee Hillary. He's a tough competitor. And will Mr. Biden be able to perform? Because one of the allegations of President Trump is that Mr. Biden is at 77, not up to the task. Will there be a growing awareness of climate change as the devastation in the West, in your wonderful state of Colorado and states to the West? Will that bring a growing awareness of climate change as an issue? Because quite frankly, that's an issue that favors Mr. Biden. If law and order favors Mr. Trump, climate change favors Mr. Biden. And finally, my sixth is, what will be the African-American turnout? Because the undervoting of African-Americans, especially in Milwaukee, was one reason that President Trump won Wisconsin by 22,800, which is 0.6% of the 2.7 million votes cast in Wisconsin. So we are indeed a battleground state, which is much too long an answer to your question. Sir.
No, that's fantastic. Following on the heels of what you're paying attention to for the White House election, one of the questions we received was, does the control of the Senate matter, as much as the election for the White House? And we talked about this in our discussion ahead of time. I'll offer my thoughts later in terms of what the stock market looks at. But do you have any observations or thoughts about the race for the Senate or just Congress in general, and how important that may be compared to the presidential election?
How important? I can't understate how important it's going to be as we continue to sort out the issues post-election. But let me talk about the Senate. There are 35 seats up. Democrats have to capture 4. Now, I can't predict who's going to win, but I can tell you the 6 elections in the U.S. Senate that are going to decide control at this point. We're looking at, what's today, September 15th. So Iowa, Montana, your state of Colorado, Mr. Hickenlooper versus your incumbent, the Republican, give me his name.
Cory Gardner.
Thank you. Georgia, North Carolina, and Maine. And that is incumbent Collins, Susan Collins, of course. So if you have a Biden win and if the odds seems to be betting on the Democrats keeping control of the U.S. House, then the Senate is the real battleground in terms of if it's President Biden or President Trump going forward here. So I'm not predicting control of the Senate. I refuse to do that, but I can only tell you the 6 seats that may decide.
That's great. I knew I wouldn't be able to get you to make a prediction. Growing up around our dinner table, I remember political discussions. You would always say, well, one side says this and the other side says this. What do you think? And that's what I appreciate about a true journalist who represents both sides. So I knew I wouldn't be able to get you to make a
true journalist says if both sides think you're doing a crummy job, you're doing something right.
That's great. Now, from your perspective, one refrain I've heard, particularly after 2016, and as we look at where the presidential election stands now, are polls. Of course, in 2016, there was a number of polls that had Hillary Clinton ahead, and there was a great sense of surprise by many, of course, when Trump was elected. Do you think polls hold any value? Is it worth looking at them? Are there any insights that they offer, or should we kind of throw them away and say they can't tell us anything, they've been wrong in the past?
Okay, wiser people than me have referred to polls only as snapshots. If you're reading a poll today on September 15th, don't apply it to October 15th. They're snapshots. A respected pollster in Wisconsin was wrong on Mr. Trump winning, albeit very narrowly. And I have talked to him about that and more. So bottom line, polls are snapshots. Here's what I now consider when I look at a poll in terms of how much credibility to give it. What was the window in which it was taken? In other words, let me give you an example. If I'm a pollster in the field And the day before Mr. Biden announces his choice of Kamala Harris, I have to throw away everything that I asked on the day before he chose Kamala Harris. And I have to decide, do I exclude this question or do I start over? Because the whole dynamics changed. Secondly, what's the window of the poll? Is the poll window open 1 day, 2 day, 3 days? And something that I really watch now is in the fine print of polls, at least the Marquette University Law School poll tells us this sample of 800, well, the last one was 802, skews slightly more lean towards Republicans or lean towards Democrats. And I'm going to make one final point. In the wake of the 2016 major failings of polls, including some of those in Wisconsin, at times, our pollsters have jumped from sampling 802 registered voters to 1,000. So I think polls are not as, I have slightly less trust in polls than I did in 2016, but I still value them as a snapshot, but only for 1 day only.
That's really helpful. I like that framework that they can be a snapshot, provide where we are today, but it sounds like maybe the fallacy that people fall into is projecting it forward tomorrow or a week or a month ahead.
No, you can't do it.
Yeah, that's great. So speaking of looking at predictions, I know we're not going to get you to make a prediction, but there are political science professors who have, utilized and talk about prediction models for the presidential election. And, I shared two with you that I'm familiar with. One looks at just actual results, or excuse me, actual votes in primaries. The other is more of a subjective view of 13 key questions. And, it's called the keys to the election. Do you think those kind of models have any value for observers? Do you think they're maybe looking backwards and just back testing and fitting a model to what happened in the past? Or do you think there may be some value in them?
I think there's some value, but the what's that old saying? The quickest thing to change in the world is a voter's mind. So these, and you have the addition of algorithms, and okay, Amazon isn't the only one using them. The website 538, and which I respect, but that doesn't mean they're always right. Modeling is something that I have to consider, but it's on my professional margins and tangents. But again, I'm focused on Wisconsin, and I can find enough news in Wisconsin. I don't need to do a lot of national sampling. So when do I get to interview you, by the way, son?
All right, those are all my questions. Go ahead.
Okay, good. It's time to reverse the. This is what I do for a living. How does our financial markets view the matchup between President Trump and Democrat Biden?
That's a great question, and I think it's helpful to take a step back and think before we think about the stock market and the election, to think about how does the stock market view the world? What's important to it? And I think the first thing the stock market looks at is where are we as a U.S. economy and globally, where are we in the economic cycle? And meaning usually it's a 7 to 10 year period of usually recovery from the prior contraction, growth, plateau, and then a contraction. And so often that's the overriding force that the stock market is looking at. And often where we are in that economic cycle is more powerful than kind of a short-term blip of who's elected into the White House. And now the exception to that is if there's a sweep of one party into the White House and Congress, and they change tax rates or government spending or other major changes to policies, that can have a big impact on the economic cycle. It could boost growth or it could initiate a recession. So I think that's helpful to think about. There's a few other things that the market focuses on. One is the business cycle. The other are company earnings and profitability. How are companies doing and what's their outlook for earning money? That directly applies to employment and how many people can be employed and how much money they could earn. It also looks at interest rates and inflation. And so those are the key things the stock market looks at. And if a political proposal or if a political policy doesn't touch on those things, the market can often be viewed as ignoring it or not caring. And it's not that things like, for example, racial inequality is not important. That's clearly a critical issue for us as a country. from the stock market's perspective, if you put racial inequality, income inequality through that lens, it'll ask those questions. Does it affect the business cycle? Does it affect corporate earnings? Does it affect interest rates or inflation? And often the answer for social or political issues is no. So you won't see much of a reaction. We saw this earlier in the summer when there was rioting in a number of major US cities. The stock market didn't have much of a reaction. I got questions from a number of clients. How is that possible? And if you use that filter for the stock market, that's an answer. So to get to the question, the market, I think, usually focuses on an election about 2 months before the election and 2 months afterwards. And often it's keying in on not only who's in the White House, but I think more importantly, who controls Congress. And to your point earlier, right now, control of the Senate is likely the biggest deciding factor. And if there were to be a Democratic sweep, then the market would probably, take Vice President Biden's proposals quite seriously. And often what happens is specific sectors are affected. So for example, Vice President Biden has specific proposals on expanding healthcare coverage through a Medicare option. That would have a major impact on many healthcare companies. He's indicated a desire for greater regulation for energy companies, also would likely have a big impact on a number of energy companies. So often what happens is particular sectors start to move leading up to the election. And I think the stock market focuses more on congressional races than the White House, but that's usually what happens. Usually get sector specific volatility. And then finally, usually the volatility we see leading up to and after an election usually falls into the category of normal volatility, meaning maybe the market is plus or minus 10% from recent prices. And for an individual investor, that can feel disconcerting. But if you look at history, a move of plus or minus 10% happens usually about every 9 months. So it's fairly run of the mill, but usually when we're looking at election, we'll say, wow, the market's really moving up or down, and it may be plus or minus 10%, but historically that's in the range of normal volatility. That's normally what we see immediately before and after an election.
Well, okay, but here's the danger when you ask a career journalist to participate in the podcast, because here's my follow-up question, Eric. In light of the social unrest and riots, is the market or financial interest more concerned about racial inequities and social justice than it was 8 months ago? And one of the most amazing stats that I've found is that the average assets of an African-American household are $17,000. The average household's assets of a white household, $170,000, a 1 to 10 disparity. So are the markets more aware of the racial inequities and social justice questions than they were 8 months ago?
It's hard to know when the market is moving up or down, what is particularly driving the market that day. For example, we may have social unrest and riots in Kenosha at the same time that there is news or concerns about trade disputes with China. May happen on the same news day. And it's hard because those factors come together. In general, what we've observed is that when there has been social unrest and riots, the market has not moved down notably, and that's over successive periods. So you can probably say if there's been, let's say 20 or 25 days out of the calendar when the market was open and there was social unrest, did the market move down? No. So in general, you would look at that and say the market is probably judging that this won't have a big impact on the business cycle or corporate earnings. But a counterpoint to that is that many market observers who focus on environmental, social, and governance concerns for companies, known as ESG, or otherwise known as socially responsible investing, have noted that companies that score higher in those categories, meaning they treat employees carefully, they try to promote more women and people of color. They focus on their supply chains and try to avoid unfair, unethical practices in their supply chains. Many of those companies have performed better year to date than their peers. And market observers have wondered, is this the market starting to price in the competitive advantage that ethical, socially conscious companies may have? And so that's the one insight that we have that may be seen. It may not move the market globally, meaning the whole S&P moved down. But if you look a little deeper, companies that seem to treat people and their communities better seem to be performing better.
Thank you. That's absolutely fascinating. Okay, next question. What can we learn from past elections in terms of the impact on markets?
I think it's really interesting to look at the data here. A major investment firm called Dimensional Fund Advisors, it's been around for about 35, 40 years, did a study and showed that in presidential election years, out of 23 election years since 1928, 19 of them have been positive. So the data shows, just looking back in general, presidential election years are positive. And I'm going to just share a graphic here so that everyone can take a look at what that data looks like. But what we're looking at here is in the green bars, it's a return, in the gray bars, it's a return during the election year. And you can see for the majority of these election years, that's a positive number, only a small number are negative. And then there's a green bar that shows the return for the subsequent election. Also, in general, positive, although there is more volatility and more negative bars in the second year. So in general, as an investor, you would look at this and say, in general, election years are positive. Now, if you look at the data over 4 years of a presidential term, this is the next chart we're looking at. This shows that in general, the stock market, if we use the S&P 500, looking back since 1929, in general, over a 4-year period, the returns are positive. And so from an investor standpoint, I think a key takeaway is that in general, there may be volatility leading up to an election and afterwards. I think it's often sector specific, but it doesn't pay to try to invest your politics or try to time those markets, because in general, if you're selling out or trying to go to cash, you will generally miss these positive trends. So I think that's one lesson for investors. The other is, as I mentioned, don't invest your politics. One thing we can see from the prior slide is that the market has generally gone up in election years and the subsequent election years, regardless of political party. And we saw this in 2008. I had a number of clients that were Republicans and said, "Oh, I just can't believe, a Democrat is, in power and Congress is, Democrats, and oh, this is terrible." If they would have gone to cash, they would have missed one of the best stock market rallies we've ever experienced. Fast forward to 2016. There's a surprise election of President Trump. A number of clients I work with on the other side of the spectrum said, "This is horrible, can't believe it. This is, I think this is going to be horrible for the country." If they had kind of invested their politics, they would have missed a great year, not only at the end of the year 2016, but a really phenomenal 2017. So I think as an investors, in general, you probably don't need to react to the election, and certainly don't vote your politics.
Okay, but here goes the journalist in me again. You ready? I saw a CNN headline 2 weeks ago. Market, I can't make this stuff up. Headline, market has priced in Biden win. Your reaction, please?
I would, if I was a commentator on that show, I'd say, what's making you say that? What's your kind of analysis, or what tool are you using to do that? Often for, I think, news value, commentators will look at how the market is performing over a period of days, maybe a week or two, after something happens politically. And so I've often heard news articles that'll say something like, the S&P is up 4% since Joe Biden announced, Kamala Harris as his running mate. And they'll say, therefore, the market is pricing in a Biden win. Or they'll say something like, healthcare stocks are up since so-and-so, therefore the stock market is pricing in Biden win. I think that's often kind of flimsy analysis. What's interesting is there is one way that the stock market has been an incredibly good predictor of the outcome of the national election. And this goes back to 1928. If you look at the stock market performance 3 months before the national election, if over 3 months, a broad index of the stock market, like the S&P 500 or Wilshire 5000, if that index is positive over 3 months lead up to the election, virtually always the incumbent or the incumbent party stays in power in the White House. And so far, that would favor President Trump. As you said, we have many weeks to go, and if COVID increases, and if there's a number of cases or restrictions, or the stock market really takes a dive, it'd be very negative outlook for President Trump. But right now, the stock market is pointing to a re-election by President Trump. We'll have to wait and see what happens, but that is one pretty reliable indicator in what the stock market is pricing in. These other ones are fairly short term, and I think just guesstimates.
Okay, but what about the statement that President Trump made at a public rally, I don't know, 2 months ago, 2.5? It's very short. If Mr. Biden wins, quote, the market will crash. Your response to that?
I think that gets to two questions. One, is it a contested election? And two, how will the market respond? And so I put together some information on what I see as kind of the key policies, and it goes to your question about how might the market respond. And so I wanted, let's just look at kind of the key policies of each candidate, because I think this will answer your question. And so what we're looking at is my summary of some key policies in three areas: the economy, taxes, and healthcare. And under the economy, President Biden, looking at his platform, has said he'd like to spend, $2 trillion on infrastructure, and is emphasizing the stimulative effect of the spend and also the jobs. He'd like to increase minimum wage, increase unionization. And President Trump also has put forward infrastructure spending proposal, about $1 trillion, no increase to minimum wage, and he's clear that he'd like regulations that favor employers. So on that, the market might be a little bit of a push. The market's going to like infrastructure spending. It's not going to like increases to minimum wage or increased unionization, because that means less money for kind of company earnings. That sounds cold-hearted, but that's kind of what the market looks at. It's not a moral judgment, it's an economic or financial judgment. But I think the thing that the market will really key in on is what I've highlighted here under the second category, which is taxes. President Biden has been very specific in his proposals that he'd like to reverse the 2017 Tax Cut and Jobs Act marginal tax rate decreases for the highest earners. And this means for families and individuals earning more than $400,000, he would like the tax rate to go up. In addition, he'd like any capital gains over $1 million to be treated as ordinary income, which would be a significant increase in tax rates. He'd also like to increase payroll taxes to 12.4% for those earning more than $400,000, and then also increase the corporate tax rates from 28 to 21%. And a part of his political strategy is to tell middle-class voters, you wouldn't pay anything more, and you may pay less in taxes with an increased child credit. But for those, kind of those wealthy taxpayers, they're going to pay notably more. And the Wall Street Journal did an analysis last week of 5 different households. And the household that had the largest increase are those that are business owners that have a pass-through entity, because they would lose the benefit of the tax deductions. So I think what the market would really key on is not so much if Biden was elected, but if Biden and the Democrats sweep, then I think the market would price in these tax increases. I think the market, under the framework I described before, would say, that means companies will have less money to pay people, so there's less employment, and individuals will have less money to spend. That'll be less economic growth. And I think the market would price that in. I wouldn't be surprised if the market would have a maybe 10 to 20% kind of repricing if it looked like these policies were going to become law. That's only likely in a Democratic sweep, which we can debate. We'll see what happens. If Trump is elected and there's gridlock between the White House and Congress, then likely it's kind of small proposals. If there's a Republican sweep of the White House and Congress, then we'll probably see more favorable tax rates. They may become permanent rather than sunset in 2026. And we also may see some other favorable regulations. So I think, to your point, that is what the market will pay most attention to. And if it's Biden with a Republican Senate, there's kind of some gridlock there. If it's Trump with a Democrat legislature, some gridlock there. But if there's a sweep, which did happen in 2008 and did happen in 2016, for at least 2 years, voters in America have given one political party the chance to control the White House and both houses of Congress. It seems as if American voters say, hey, take your best shot. You have until midterm elections. If that happens with a Democratic sweep, I wouldn't be surprised if the market would price that in.
Well, Eric, the CARES response by Washington to the pandemic has just been so intriguing, because you start out by giving many workers an additional $600 a week, including consultants, which was new. And in Wisconsin, our maximum UI weekly benefit is $370. So I know somebody who was laid off. He gets a $370 plus he got through the end of July, the $600. And he looked at me and he said, that's pretty close to what I was making. Um, but there's I'm so intrigued because it seems to me a precedent here. And correct me if I'm wrong. I'm not saying it's a precedent. So we made a decision. The federal government made a decision that we need to preserve a lot of small and medium-sized businesses. Was this the first time? First of all, if it's a precedent, is it the first time that we made a decision to try to preserve these businesses? And what are the long-range consequences? Because didn't you once tell me as we got ready for this show that Japan did this and X decades later, it's not working out too well? So was this a precedent? And do you think it was a wise precedent?
You know, as I understand it, I think there is a new precedent that we've undertaken as a country to try to prop up businesses, and you can view it from two different lenses. One is that if we all think about the businesses that are down the street from us, hairdressers, pizza parlors and restaurants, bars, other kind of local small businesses, those really are the the heart and soul of the U.S. economy. They employ the large majority of employees, and if you tell them that they can't operate for 3, 4, 6 months, there are a few businesses that have enough cash reserves on hand to survive that. And so if those businesses go away, there's a massive spike in unemployment. And a number of people in March and April were forecasting that if the majority of those small businesses went out of business, you could have unemployment that would equal or even exceed the unemployment in the Great Depression, meaning 25, 30, 35%. And if an economy gets to the point of that kind of unemployment, it's very difficult to avoid deflation, which is where people expect lower prices because businesses are going out of business. And so they hold off on purchasing. That lack of purchasing, bankrupts companies, and then there's further spiraling down. And there's been a lot of economic research that says deflation, when customers assume prices will get cheaper because the economy is going into a depression, is almost impossible to defeat. And so the economic viewpoint would be do anything you can to avoid deflation, where a large number of people holding back because they think everything they want to buy will get cheaper. So that, I think, is the economic framework behind the enhanced unemployment benefits, behind the PPP loans to individual businesses. I'm not aware of any sort of actions have been taken like this by a central government. Certainly there have been lower interest rates in the past. Certainly unemployment insurance has been used, but by all of these tools coming together at once, I'm not aware of that. And we'll have to kind of wait and see what's happened. So far, it seems to be a positive economic impact in the sense that consumer spending has actually recovered. And so people that have jobs feel comfortable spending. That's a good sign. They're not expecting deflation. And that people who may have lost their jobs have enough to pay rent, buy food, pay their heating bill. That's very positive for an economy. So it's unprecedented. I think the open question that we'll have to deal with is it a threat to us as a country to take on this much debt? And that's the one thing I hear from people repeatedly is, what about the debt? What about the cost of this? But in the short term, it's probably, avoided a potential depression or deflation. And you can hear that in the Federal Reserve recently said that they want to maintain a higher than normal policy to pursue high inflation. They're basically trying to flood the market with dollars and people spending to try to get enough demand that inflation happens. And they're hoping that happens. And because they want to avoid deflation, that's how scary it is.
Well, okay, but I looked it up today. So we were at about 15% unemployment in March or April. Today's stat is 8.4. But I went to the national debt clock to get ready for this, and it's 26.76 billion. So talk to me about the long-range implication of debt, or more simply, when does that piper have to be paid, and who's going to pay it?
That's a key question. I'll share a graphic that just shows the range of federal debt as a percent of our gross domestic product. And one way to think about a gross domestic product is that it's similar to kind of our income or our output as a country. It's not an ideal comparison, but it's similar to that. And so the absolute dollar amount of the debt is not so important. It's more in relation to our income. And this is similar to individuals. If you have, $20,000 of debt, is that a problem? Well, first I would have to know how much money and assets you have. If you have $10,000 of assets, that's a big problem. If you have 500,000, it's not a big problem. So you can see since 2010, the ratio of federal debt to GDP has slowly gone up. And this is partly as a result of the Tax Cut and Jobs Act. That was, part of the, projected impact was to significantly raise debt relative to GDP. It was one of the main criticisms of it, that we lowered taxes in the, towards the end of a big expansion. But when you see that big red line jumping up, it's an updated projection based on current law and based on current stimulus. And so often I hear people compare the United States to a household. And that is a little bit of a fallacy, because a country is not like an individual household. People often say things like, hey, as an individual or household, I just can't keep borrowing money. Eventually, that falls apart. And it's not exactly true, especially for a country like the United States, because our currency is used around the world and everyone trusts our currency. And so we can continue borrowing and printing money. That's not a problem. The problem is at what rate is your debt growing relative to the rate of your income growing? So for example, if your debt is growing in a small, rate, but your income is growing quickly, that's no problem. That would be like if someone took out a modest loan to go to law school, after they got done, their income was going to be much higher and it wouldn't be a problem. The problem for us is that the rate of growth in our debt is growing significantly higher than the rate of growth for our income, in this case, GDP. GDP is looking like it's going to grow maybe about 2 to 2.5% per year for the next 10 years. On the current trajectory, our federal debt is growing anywhere between 7 and 10%. It's hard to know. So eventually we will face a problem where our debt service costs, the interest, and the amount of money we're dedicating towards it are a problem. Now, if you're borrowing money as a country to invest in things that increase your income long-term, like infrastructure, basic research, education, that's great. The problem we have as a country is that the majority of our debt is used to pay for social care programs like Social Security and Medicare and Medicaid. Those are not bad investments, but they don't stimulate growth. Economists would say they're, only okay to poor investments. So we're borrowing money to spend it on things like healthcare and care for our citizens, which is not bad, but from an economic standpoint, it's not going to create economic growth that we need. So eventually this will come to a head.
Well, I know we want to phase into questions here in a little bit, but here's a journalist in me, Eric. Okay, we have a pandemic. We have hurricanes that are ravaging the Gulf Coast right now. We have wildfires in the West. And yet, if you look from March, April to now, the Dow's back 40%, NASDAQ is back 30, and I think the S&P may be back 50. I don't get it. Why, in light of these national crises, are these financial indicators, albeit only 3 of them, rebounded so strongly?
I hear this question almost every time I tell people what I do or talk to clients. And I think when we think about the framework I shared at the beginning about what the market cares about, where are we in the economic cycle, what is the outlook for company earnings and profits, and what about interest rates and inflation, we get an answer. So part of it is that the CARES Act injected so much stimulus into the economy. It was almost as if you had a patient on the hospital bed and they just gave them a shot of adrenaline. And that is the effect when the government sends out one-time checks. Many people just got a check in the mail from the US government. To my mind, I think that's the first time it's ever happened. When they send out checks, when they increase unemployment benefits, and they make somewhat large loans available to companies, that's an infusion of cash that the market looks at and says, I'm not going to make a judgment on whether this is good or bad politically. I just know there's a lot of money in individual and companies' hands. They're going to spend that. And that's what we've seen in corporate consumer spending. So the market views that as positive. The second thing that's happened is that the Federal Reserve lowered interest rates, and interest rates indicate the cost to borrow money. And so if you lower the cost to borrow money, borrowing debt becomes easier, it's less expensive to do, and often it becomes more accessible. So the market looks at that and says, how many individuals are potentially going to, borrow and use their credit cards, maybe the same or more? How many companies are going to have favorable interest payments If they have a variable loan, which many corporate loans are variable, more. So I think the stock market does the analysis and says, okay, we have companies with more cash who are going to pay rent, buy inventory, they're going to pay employees, they're going to stay in business. We have consumers with more money, more unemployment benefits, and we have lower cost of borrowing, which means individuals and companies may borrow and then spend that money. And I think the market goes, it's all pretty positive, at least in the kind of 6 to 9 month period I find the market often focuses on. So I know it seems like a disconnect, but there have actually been multiple periods in market history where the market has seemingly completely disconnected from what's happening right now in the economy. And often what that means is the market is looking forward, often usually about 6 to 9 months, to say, here's where we think the economy is going to be. And the market, I think, really plays chess, not checkers. And often I think we are a little too simplistic in the way we think about the market. We say unemployment now is bad, for example. We have social unrest, therefore it must be bad. And I think the market is thinking, well, we're thinking 12 steps ahead. We're thinking about what capital spending is going to be like. What is consumer spending going to be like in 6 to 9 months? And then the market says, I'm going to price that in now. And so the market does not always get it perfect. It's their best guess of the future. Frequently, the market has predicted great things and they've done poorly, or the market has been concerned about a recession and it hasn't materialized. This is why, as investors, you do have to be careful. You're going to try to get into the market and try to time it. If you're going to try to go to cash when you think things are going to go bad, or get really aggressive when you think things are going to go well, often what happens is that people that do that are looking at current events and reacting to current events. And so, for example, someone who did that in April would say, unemployment surely going to explode, GDP will be negative, I'm going to go into cash. And they would have missed one of the greatest rallies we've seen in the history of the stock market in terms of how big it is and how quickly it's happened. So I think, my takeaway for participants here is that I don't think we should try to move our stock market portfolio. But one point I would leave people with before we go to questions is I think from a personal tax planning standpoint, I think the opportunity and the takeaway for listeners is the potential impact of a Democratic sweep could be significantly impactful for higher net worth families. And I'll briefly go over this. I put up a slide here, planning for a potential Democratic sweep. And I think this is a key takeaway. You don't necessarily need to rebalance your portfolio or try to trade the election. I think that's one of the takeaways from prior data. However, if the Democrats sweep the White House and Congress, potential policy changes here, higher income tax rates are very likely. And so I've listed some potential actions that higher net worth families can take. You can take capital gains this year to avoid future higher capital gains, pull income into this year, sell your business in 2020, if at all possible, and consider converting an IRA to a Roth IRA before the end of the year to take that kind of income in this year. And you may want to transfer assets to family members. Those are all things you can look at for higher tax rates. Another thing we didn't talk about is that Vice President Biden has talked about lowering the estate tax exemption from 11.5 million to something notably lower, possibly 3 to 5 million. And for families that have assets in excess of 11.5 million if it's an individual, or 23 million, this is the time to start planning. And we've seen this in the past. If there's a potential change to something like the estate tax exemption, if you wait until after the election, your CPA and your trust and estate planning attorney are not going to be available to meet with you. They are going to be too busy working with clients. So if you are concerned about this, if you're in this high net worth space, you may want to consider reaching out to your CPA and your trust and estate attorney now to think about some of the things I've listed here, like make outright gifts, create a spousal limited access trust, donate highly appreciated stock, consider gifting strategies. And if any of those may apply, if you are in this larger bracket and your estate tax may go up if there's a Democratic sweep, I encourage you to reach out to your CPA and attorney now and potentially ask your attorney to draft documents before the election. The reason why is that I don't think your attorney will be available after the election to draft documents. So only have a handful of weeks and they'll be backed up. But if you investigate this with your tax advisor and your legal advisor and they say, yes, I would consider doing this, draft the document now. You don't have to sign it. And if there's a Democratic sweep, you can sign it if you and your loved ones are comfortable with it. But don't think that after the election, in that short window of time from the election to December 31st, you'll have enough time to do the tax calculations and get on the calendar of your tax and legal advisor. So that's, I think, the biggest takeaway I would focus on. It's not so much about the stock market, it's about taxes. And here's some ideas that I put up on the screen for people to consider.
Can we have one quick question before questions, Eric? Okay, there's now gridlock, impasse in Congress on another CARES package. Both sides have basically walked away. Assuming there's no new CARES package, are there any implications of that for the presidential election 7 weeks from today? Just quickly, since I know we want to go to questions.
Yeah, I think that it's kind of a trope that citizens always appreciate, stimulus and lower tax rates. I think it's true. So I think if there was a stimulus package, I think it would increase voters' favorability towards Trump, and probably the Republican Party. They would probably take credit for that. So if there is no new stimulus, I think Democrats have a window and maybe a wedge issue to kind of say, hey, you're talking about what the economy was like before COVID, but people are hurting now. And particularly to this point of any new PPP loans, the existing PPP loans need to be used by December 31st. If there is not a new wave of PPP loans, I think there will be a wave of business closures and bankruptcies at the end of the year, because I think that money will have been used. Particularly restaurants may not be able to operate in colder weather the way they have before. I don't know if voters will focus on that as much, but it's up in the air. So I think a stimulus would be positive. I'm doubtful of whether it happens at this point.
Well, the key word there, at the end of the year for some of those potential business closings, because that's right after the November
election,
just this way. Okay,
exactly.
Thank you.
All right, so we're going to switch to questions. We've got a few questions that have come up ahead of time. And Dad, well, we've talked about control of the Senate. That was one of the questions that came up. And I wanted to see if you had any other comments about control of the Senate or control of the legislature relative to the White House. I know we touched on it, but wanted to see if you had any other questions.
If Senate Majority Leader McConnell remains in control of the state Senate and you have a President Biden, I think the tenor he set with President Obama, I think that continues. Remember, President Obama forwarded the name of Merrick Garland to the Supreme Court, and it's the right of presidents to forward names to the deliberative advise and consent U.S. Senate, and Senator McConnell chose not to do that. I think if we have a President Biden and a U.S. House and a Republican Senate, I think it's going to be more gridlock, impasse, in your face. So that's why these 6 key Senate races are really important in terms of unified Washington going forward or continued gridlock and scorched earth in terms of your opponent.
So speaking of gridlock, we've had a question come in, and I have heard this multiple times, and I appreciate this question, that people are concerned about the possibility of armed conflict. The question uses the phrase civil war, kind of as a result of kind of our tribalism and our conflict and the level of polarization. And I've seen this, in Utah, there was armed militias patrolling the streets. You've heard, I think, groups on both the right and the left saying we may need to arm ourselves and enforce the law or protect our people. What's your outlook of the potential for armed conflict or even something like, a civil war?
I want to believe in the soul of Americans that we're better than this, that we can get past this, that we can accept whoever wins on November 3. I understand when there are assault weapons in the Michigan State Capitol, having worked in state capitals for most of my 51 years, that's pretty chilling. But I want to believe that the better angels of Americans will accept whoever wins, and it's important the conciliatory tones of the president-elect. So I recognize the urgency. I recognize the seriousness and the threat, but I believe in the fundamental goodness of Americans to say, okay, it's been a difficult time, but we have to move on. There's just too many important issues. So I'm hopeful hopeful.
Well said. A follow-up question to that was, for me, if that happens, what would be the impact on the market? I think at first, the market may not have a huge reaction, and this may be small, isolated social unrest like we've seen at some state capitals. Think about Portland, Kenosha. So I think if it's related to kind of protests downtown, but if that leads to armed conflict and there's the National Guard called in, that usually leads to curfews and then a decrease in the ability for people to move and or engage with companies they'd like to buy from. You can't probably go buy a car. You probably have to stay in your house. So I think if it were to get to that point where National Guard was called in, that there was open conflict, maybe that there was actual sustained violence more than just maybe an incident around a riot, then I think it would have a similar impact on the market as COVID shutdowns. In a sense, I think the market would view that very negatively. And of course, the damage to property and the damage to a business we've seen in downtown, and that tends to have a dampening impact on the local population. They don't want to go out. So I think from a market standpoint, the market would view that really, really negatively if it moved beyond kind of local riots or.
Eric, I also
problems.
think there's a generational debate to this question. Mr. Biden is 77, the president is 74. Kamala Harris is 55. I'm sorry, Mr. Pence's age escapes me. But if there is an election, an emergence of a younger generation of leaders that are willing to dialogue on both sides of this issue, I hope we have to see a generational passage in this country. So if we elect a younger set of generational leaders who are able to get into this dialogue of civil unrest, that is another source of my hope.
Well said. We've had another question come in, and before I answer that, I want to encourage everyone, if you do have a question, feel free to type it in on the Q&A button that should be on the bottom of your control panel. We'll try to get as many as we can. But there's another question that came in that refers to Mr. Biden said he is willing to shut down the country if a new wave of COVID infections hits. How would that impact the economy and the markets? I think it depends if it's kind of countrywide. What we saw with President Trump is that he deferred to governors. And we had a fairly interesting quilt of responses. For a while, you had, for example, the Dakotas saying no restrictions. And then, of course, you had New York Governor Cuomo saying all decisions come through me. And, Mayor de Blasio, you have no say in this. And then California enacting its own restrictions. So if that kind of state-by-state policy was changed, where it was a national mandate, everyone was shut down, here's what the rules are, I think you would have a repeat of what we saw in March in terms of the market response. I think the market would decline pretty seriously. So there's, Dad, sorry, do you have any thoughts?
No, I would just like to know, you and I've seen that ad where Mr. Biden says, lock it down. I wish I knew the date he said that, because things are so moving quickly here. When I started out in this business, we talked about morning and AM news cycles. Now there's a 24/7 news cycle. So was that said 1 week ago or 3 months ago? Because things are changing so much in this area that's a very historical perspective. But by the same token, when you look at some of the statements by President Trump, he said the hoax phrase a long, long time ago. And now that's coming back to haunt him. So the immediacy of all these news developments can be overpowering in terms of us informed voters for our fragile democracy. So let's put some of these dates in context. Excuse me, go ahead, Eric.
That's a great point. And I think to respond to that, I think what's really interesting is we're dealing with a natural disaster that is unfolding over time. Often we think of natural disasters as one-time events. There's a hurricane, there's an earthquake, we deal with it, and then we move on. But this natural disaster is continuing to evolve, and we could both see situations where over the next 7 weeks, COVID cases could spike. There could be restrictions and shutdowns, and President Trump's words that he would like to underplay it could hurt him significantly. And of course, it could probably drop the market lower. Conversely, if cases move down and the stock market continues to hang in there and potentially move up, then Biden's phrase that he's going to lock it down would probably be a real liability for him. And you can imagine these playing out in the debates and, of course, in attack ads. So I think that's a real wild card that both candidates and campaigns are dealing with.
Here's another wild card. Are there going to be additional news stories that I have nothing to do with? I mean, I'm a journalist, but I'm a Wisconsin journalist, because in the last 2 weeks, a journalist reported in the Atlantic about disparaging remarks by the president about those who tragically lost their lives in uniform. And then you have the president's own words in the book Rage from another journalist. Are there more of these news events that I know nothing about? I can't predict, but over the next 7 weeks, are there going to be more of these news stories?
It's a great question. All right, we have a few more questions I want to get to. One is, how do you see the election impacting private equity and mergers and acquisitions transactions? I'll take this the lead on this one. I think individual business owners, if there is a Democratic sweep, would probably feel very threatened by higher taxes and would probably try and push to sell their company by the end of the year. That's very difficult to do. Usually you need probably 6 to 12 months to sell a company, but they may be able to make some transactions. So I think there may be a large number of business owners that may try to sell, and conversely, private equity may have a hard time purchasing businesses because it may trigger large taxes for often an individual who owns it. So I think if there's a Democratic sweep, it could have a major impact on private equity and mergers and acquisitions. And for private equity managers, Biden has talked about changing what's called the carried interest rule. And that just means more favorable tax treatment for their own interests. And if that's changed, then you could imagine some changes in private equity. Another question we received was, what's the outlook with very low interest rates for inflation and bonds? And so I'll take another stab at this. The Federal Reserve has lowered interest rates. Right now, inflation has been very low. And so bonds serve as a source of safety, but we're not earning a lot of money on them. Maybe 1%, 2% per year, which is quite low by historical standards. If interest rates stay low, investors have this conundrum. Do we stay with safe bonds or do we take risk elsewhere? And I don't want to opine, for anyone's individual situation, but it's a difficult thing to grasp. And so I think that's a hard thing to do. I think that requires probably some individual advice. But the outlook for inflation, I think, will stay low because we're not at full demand. If everyone is employed and everyone's trying to go to a restaurant and buy food, prices will go up. But as you mentioned, unemployment is still around 8%. We're not at full demand or full kind of capacity. So it's unlikely, I think, that inflation will spike. So I think on the bond side, it's unlikely you would lose a lot of money, I think, over the next 2 or 3 years, but interest rates are quite low. And there's another question that's come in. Given the unrest in many city centers and the shift to remote or virtual work, do you foresee a population shift towards suburban areas? If so, who would be the economic winners and losers? That's interesting. So Dad, I'm gonna ask you to first weigh in on, is there a election impact on voters moving from maybe more of a city center to the suburbs? If there's potentially more suburban voters, does that have an election impact first?
Election impact, I think people, first of all, I think you're going to see a trend of people moving from our urban areas to the suburbs, further away. There was just a story yesterday, people leaving San Francisco going to where? Utah? It's more affordable. But right now, if I'm a parent, I'm worried about, are my kids in-person learning or online? I'm trying to find a way for, look at your brother, four kids learning online. He's working from home online. I've got a few other things, and I've got 7 weeks to worry about the election. So I just don't know if the shifting trend to online, which I think is going to stay, we're only talking about how many workers 2 years from now are going to be working online. It's going to be more. I think we have a history of late deciding voters. So as I sort out things like how's my kids online or in person, and how big is my bubble, my anti-COVID bubble, I can't predict the impact of the shift to working from home on the election. Sorry, I just can't go there. There's too many unknowns.
Who can? I'll take a stab just at the idea of winners and losers and a shift from maybe everyone kind of working downtown to maybe working remotely or in suburban centers. The question asks, who would be the winners and losers? I think first off, landlords are likely going to have much more available space over the next 12 to 36 months. They may have companies kind of locked into leases right now. From what I see, a number of companies are allowing a lot of knowledge workers to work remotely. And that means that eventually when those companies choose to renew their leases, they will probably have a very different physical footprint. So I think commercial landlords could have fewer restaurants or retail customers. I think that'll put pressure on prices. I think lease rates will come down. Demand for office space will probably come down. And demand for office space in the ritzy kind of downtowns will probably move down. I've talked to a number of professionals like CPAs and attorneys who say, my clients don't really care if I'm working from home as long as it's a professional background and I'm dressed, in a normal suit. They're looking for good advice. So I think real estate would take a hit. I think a number of manual and labor-intensive businesses could be hurt, and those workers in particular, because if you're a knowledge worker and you can log in from anywhere, this hasn't affected you very much. But if you have to be at work for your work, threats to your safety weigh in. There was a Wall Street Journal article about how the infection of COVID, the homeschooling of kids has taken so many women out of the workforce. They've said, hey, I can't be a nurse. I can't drive a bus. I can't serve food. I can't run the machine and help my kids. I'm not a knowledge worker. So I think that is going to have a really negative impact for a number of people that have often those lower paid, lower knowledge level jobs. That's negative for us as a society. We want as many people as possible earning as much as possible. And so that's a real negative for us. And then of course, you can't go a day now without talking about technology companies, how investors have ballooned their stock prices in, I think, a belief that their profits will continue. Companies like Zoom will do great. We're using Zoom right now. Companies like Amazon are incredibly profitable. I think that is a little bit of a bubble, but there certainly have been a lot of technology winners.
Okay, Eric, I've got to interview a candidate for the state assembly here in a few minutes, but one last question. 7 weeks from the election, have all the cards been played on the financial market, or could there be some big surprise to affect the Wall Street and investors? Just quickly, because I got to bail.
I think the top candidates are a stimulus package could be a surprise. Right now, it may not be kind of priced in. So that's a potential. A large upsurge in COVID cases leading to restrictions, that could be a change. And then if candidates pivot their positions, one candidate may feel behind in polls and may feel that they're going to bring out a new proposal. They're going to try to appeal to a certain part of the electorate. That's always a possibility, but those first two seem more realistic to me as potential threats.
Okay, thanks for giving me a chance to demonstrate how much I don't know about your area of expertise, but I love asking questions.
Likewise. I want to thank my dad, Stephen Walters, for generously taking time. He is in the middle of campaign coverage in Wisconsin. I think he did 13 interviews yesterday, so I thank you for taking time out of your busy schedule. I also want to thank all of the people who have joined us live and those who are listening to a recording. To those who are listening now, I do want to let you know we will release a recording that will include video and any of the slides that we shared. If you have any questions about any of the information we shared, feel free to reach out to me at ewalters@summithillwealth.com. You can also visit our website, summithillwealth.com, if you have any questions. And Dad, they can find you where? What's a good way for them to follow your coverage and to see you and your political work?
All my broadcast interviews and my weekend review is at WISEY, WISEYE.org. It's a nonprofit. Eric, it's been a pleasure. Thank you so much.
Thank you very much, and thank you, everyone.